Picture this, the stock market plunges thousands of points, billions of dollars vanish in the blink of an eye. And just as quickly as it fell, the stock recovers. Welcome to the chaotic world of flash crashes, which is what we will be speaking about in this video today. So today we're going to be looking at flash crashes, what causes them, why they happen, when they've happened before, and just diving into what a flash crash actually is. So what is a flash crash? Essentially, it is when a specific stock plummets dramatically within minutes or seconds, only to recover in the same amount of time. So it is very short, it's very dramatic, and you can basically think about it as the market just having a hiccup. So these are not new things, but in an area dominated by algorithms and high-frequency machines that control the markets essentially, these have become a bit more frequent and more mysterious. So to put this into perspective and to give an example, the most infamous flash crash of the more modern history was in 2010 when the Dow Jones plummeted over 1,000 points, which was over 9%, and trillions of dollars were lost in just 36 minutes. No one knows what the exact trigger was, but essentially you can think of it as was this the perfect storm of market conditions, human error, and tech glitches, which probably all caused this flash crash. So when we look at it, flash crashes can be caused by mainly 5 things, even though nobody truly knows what the exact cause is most of the time. These 5 factors generally cause dramatic swings in the stocks. The first condition would be algorithmic trading, because bots that react to the changes in the market react by the millisecond, and sometimes they can overreact, and this could then cause the stock to really fluctuate a lot when nothing has actually caused that. A low liquidity as well. If there are not enough buyers and sellers in the market, then prices can be quite volatile, and then this can affect the stock and the share prices, but maybe not to the extent where it has massive flash crashes. A third point could also just be human error, because people make mistakes sometimes. And a fourth problem could just be the market structure, because the interactions that take place and how complicated they are could really just amplify the problem. So the 2010 flash crash caused a lot of reforms because a lot of people lost confidence in the stock market and were scared, understandably. So new reforms were put in with things like circuit breakers and pauses on markets that were moving too quickly. However, this doesn't stop these crashes from happening. In 2018, Japan's stock market had a flash crash, and in 2015, the US dollar had the same thing happen to it. So these reforms do help prevent the crashes, but they don't stop it ultimately. As markets become more automated and move at a faster pace, we can definitely expect to have more of these crashes unless more reforms are put in and more changes are made. Question comes in is whether you think that flash crashes are just technological glitches or whether they're actually a sign of something bigger and possibly something fundamentally wrong with the market. So that is something to think about when we look at these sorts of crashes. That brings us to the end of this video. Thank you for watching, and I hope that you enjoyed learning about the flash crashes of the market and why they happen.